Ladies and gentlemen, the market doesn't punish ignorance. It punishes confidence. The people who lose the most money aren't careless. They're intelligent. They trust their logic. They trust their analysis. And that's exactly why they hesitate when they should act, and act when they should wait. Power has always worked this way, not by defeating the weak, but by exploiting the blind spots of the smart. Because when intelligence becomes identity, admitting you're wrong feels worse than losing money. Markets don't move on numbers. They move on fear, ego, and belief. And once you understand that, you stop trying to beat the market. You start understanding it. Intelligence is often treated as armor in financial markets, but in reality it can become a liability. When someone is smart, analytical, and well-read, they slowly build an internal narrative that they understand how systems work. That narrative turns into identity. The person is no longer just analyzing markets. They are proving their intelligence through every decision. Once intelligence becomes identity, flexibility disappears. The mind starts defending its own conclusions instead of observing reality. Highly intelligent individuals are trained to seek coherence, patterns, and explanations. Markets, especially crypto markets, are not coherent systems. They are chaotic, emotional, and often irrational. A smart mind struggles with this. It wants reasons. It wants structure. When prices move without logic, the intelligent investor assumes the market is wrong, not their model. This creates a dangerous delay between reality and response. Another blind spot emerges from overconfidence in processing power. Intelligent people believe they can think their way out of uncertainty. They add more data, more indicators, more theories. Instead of reducing risk, this often increases emotional attachment. The more effort invested in an idea, the harder it becomes to let go. Walking away feels like admitting intellectual failure, so the position stays open. Losses deepen. Rationalization replaces observation. Intelligence also encourages prediction. Smart people are praised for being early, for seeing what others don't. In markets, this creates a temptation to outsmart the crowd instead of understanding it. Being early feels intelligent. Waiting feels passive. But markets don't reward intelligence. They reward timing and emotional discipline. The intelligent investor often enters too soon, convinced their logic will eventually be validated. Sometimes it is. Often, the market moves against them longer than expected, testing patience, confidence, and emotional control. There is also a social dimension. Intelligent investors consume complex narratives, deep analysis, and sophisticated arguments. These narratives create echo chambers of intelligence where being wrong is reframed as being early or misunderstood. This delays corrective action. Simpler minds may exit quickly out of fear. Smarter minds stay longer out of pride. Blind spots form because intelligence reduces humility. When someone believes they understand the system, they stop questioning assumptions. They underestimate randomness. They underestimate manipulation. They underestimate how little control they actually have. Markets exploit this by rewarding those who remain emotionally neutral and punishing those who need to feel smart. The paradox is that intelligence is extremely valuable in learning, but dangerous in execution. Markets do not test how much you know. They test how well you can detach from what you know. The moment intelligence becomes a shield instead of a tool, it blocks perception. And when perception is blocked, losses feel surprising, unfair, and personal. Markets are driven less by information and more by emotion, yet most participants underestimate how deeply fear and greed shape decisions. Even when people believe they are acting rationally, emotional forces operate quietly beneath the surface, influencing timing, conviction, and risk tolerance. Fear does not always appear as panic. Often it shows up as hesitation, overanalysis, or the need for confirmation. Greed does not always look like excitement. Sometimes it appears as patience that lasts too long, or confidence that refuses to adjust. Fear enters when uncertainty threatens identity. Loss is not just financial. It feels like a statement about intelligence and competence. This is why investors hold losing positions longer than they should. Exiting would force acceptance that judgment was flawed. The brain reframes the situation to avoid discomfort. It searches for news, narratives, or comparisons that justify staying. This is not strategy, it is self-protection. Greed works differently. It expands perception. When prices rise, the mind extrapolates the present into the future. Possibility turns into expectation. Expectation turns into entitlement. Discipline feels unnecessary. Risk feels distant. The investor no longer asks whether the market is offering value, only whether they have enough exposure. Emotions react faster than logic. By the time rational thought arrives, the decision is often already made. Analyses become justification rather than guidance. Signals are followed not because they are valid, but because they align with emotion. This creates the illusion of control while reinforcing emotional behavior. Crowd psychology intensifies this effect. Seeing others profit triggers comparison. Comparison creates urgency. Urgency reduces patience. Individuals stop acting according to process and start reacting to collective behavior. This is why tops feel obvious only in hindsight and bottoms feel impossible in real time. Professional participants understand this dynamic. They do not fight emotion. They anticipate it. They position around psychological extremes, not predictions. Retail participants, especially intelligent ones, focus on being correct instead of being aligned with behavior. Information in markets is never evenly distributed. While data appears accessible, interpretation and timing remain concentrated among those with capital, experience, and emotional distance. Intelligent participants often assume effort can overcome structural disadvantage. By the time clarity reaches the public, opportunity has shifted. This is not conspiracy. It is structure. Authority shapes perception through framing. Influential voices do not need to lie. They guide interpretation. Awareness does not eliminate influence. It only weakens it. Large participants watch sentiment and positioning more than headlines. When optimism becomes widespread, risk increases. When fear dominates, opportunity forms. Retail participants move closer to emotion. Proximity reduces objectivity. Time horizon deepens the divide. Those with patience can wait. Those without are forced to act. Action feels safer than stillness. Yet forced activity is rarely rewarded. The illusion of control is strongest where understanding is partial. People adjust strategies assuming the problem is technical. In reality, the issue is behavioral positioning within an asymmetric system. Markets punish misplaced confidence more than ignorance. Those who succeed long-term accept asymmetry. They focus on risk, neutrality, and selective participation. They wait for psychological extremes, not loud information. This approach feels uncomfortable, but restraint is not ignorance. It is recognition of how power moves. Human beings seek certainty in complex systems. Markets exploit this instinct. Complexity increases demand for explanation. Markets supply endless ones. Identity ties judgment to ego. Being wrong feels personal. Scarcity creates urgency. Urgency reduces accuracy. Control becomes illusion. Narratives reinforce commitment. Contradictory evidence is ignored. Complexity replaces clarity. Losses reinforce the cycle. People seek more information instead of less. Noise increases. Adaptation requires subtraction. The market does not reward intelligence alone. It rewards emotional regulation, patience, and restraint. Understanding should lead to humility, not confidence.